Shares of Peloton are down 67% from their 52-week high. And this has been a stock that has just been absolutely pummeled since its peak during the pandemic. A ton has changed with the company, but I think now might actually be the best time to buy Peloton stock. There's a long-term recovery play here. And if we start to see momentum in that direction, this could be a company that's generating a lot of free cash flow really quickly in 2024. That's what I'm going to get into today. My name's Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. If you go to fool.com/ASYM, they're going to give you their top 10 stocks to buy right now. And I want to just start with a high-level overview of Peloton because the numbers look really bad before you start to understand the change in strategy the company's made over the last couple of years. This first chart shows revenue and gross profit for Peloton, and you can see that it grew through the early parts of the pandemic. And then in 2022, revenue really started to drop. They're in a little bit of a different fiscal year. That's why we're on June as the end of their fiscal year. But that's when revenue started to drop. And what happened was they started to ship in more bikes in anticipation of more demand. Well, then bike sales started to fall off. And that's why you started to see margins start to fall as revenue dropped. So there's two pieces of revenue that Peloton generates: hardware sales, bikes, rowers, treadmills, things like that. And then also monthly subscriptions. So we want to treat those a little bit different as investors. And we'll get to that in just a minute. But the reason for the decline recently is not because people have been canceling their subscriptions. It's because they're selling less hardware. That's actually okay long-term, especially when we get into some strategy changes in just a second. Those financial changes that Peloton went through really put a lot of strain on the balance sheet as well. You can see the blue column here is the company's outstanding debt, and that exploded to $1.7 billion. There was no debt on the balance sheet coming into the pandemic. So that's a really tough position to be in, especially when you have negative cash flow, which is the orange column. Now, if we zoom in a little bit further and just look at the quarterly numbers, you can see that things are improving pretty quickly. Cash flow, free cash flow, again, the orange column, is getting close to break even. I think could be break even in the next 2 to 4 quarters. And that will at least give the company a little bit more flexibility. You still do have that debt on the balance sheet, still about a net debt position of nearly $1 billion. So there are some challenges and risks there, and that's what investors are selling off. But there's also a lot of opportunities if the company's strategy is correct. And what's happened over the past year is that Peloton has really gone from trying to make money on bikes and then have subscriptions that are tied to those bikes to being a fitness company overall. If you remember way back to before the pandemic started, this was really a bike fitness company. That is a vast majority of the content they produced. If you go into the Peloton app today, there's going to be nearly 20 different styles of workouts that you're going to be able to do. Strength workouts, yoga workouts, meditation, all kinds of content fits under that Peloton umbrella. It's not just a bike company anymore. So what that does is it allows you to expand your market beyond the couple of million bikes that have been sold to potentially tens or hundreds of millions of potential customers that are looking for a relatively low-cost option in streaming fitness. And I think that's where the company becomes really compelling because now you can actually lower your price point, have an entry price of about $12.99 in the US, and then the full access to all of their content, I think, is $25 right now. So if you compare that to a full-service gym, you're talking about potentially a tenth of the price of a full-service gym. And that's for thousands of classes and in all kinds of different modalities and styles with all kinds of different teachers. So the value proposition, I think, is very strong for consumers. It's just a matter of, is there a big market of people who want to do that working out at home and who turn to Peloton to do that? And I think there ultimately will be, but we need to give the company a little bit of time to execute on that strategy. But there are some signs that we're starting to see a little bit of success. One is the company's partnerships with Lululemon, who is now making their apparel products. And then Lululemon actually shut down their mirror product and actually pointing their members to Peloton content. That's a really important partnership because it shows that even a company that Lululemon's size can't make enough money on creating that content and distributing it to a relatively small market of people. They need a bigger market. So they're just going to lean on Peloton to create all of that content. I think that's a phenomenal partnership, and we'll likely see more partnerships like it in the future. They just announced a deal with TikTok to distribute at least some of their content on TikTok, potentially reaching billions of viewers there. And where we're going to see this progress is on the income statement. So I'm going to get to that in just a second. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Where you're going to see Peloton either succeeding or failing is in two numbers. That's what I want you to watch in 2024. And that's the number of app subscribers that they have and the revenue and gross margin from their subscription products. So the first thing to watch is these ending app subscriptions. And this has actually struggled recently, down 13% year over year in the most recent quarter. This is basically a calendar third quarter of 2023. There were just 763,000 subscribers. But they made some big changes to the app and what was available on the app and the price points. So I think what you saw was a lot of people canceling because it was a little bit different than it was previously. And we have not seen the inflow of customers from things like the Lululemon partnership or TikTok or the broader launch that they had. So this number right here, the churn number, which they're going to start reporting, should be far, far lower than 6.3%. It should be closer to what they have with their traditional app in that 1 to 2% range. That's what I would expect. Where we're seeing progress and where if this is going to be a phenomenal stock, the kind of stock that could be asymmetric, or have a 10x return over the next decade, which I think it could, we're going to see that in subscription revenue up 1% in the most recent year, and then subscription gross profit, $279.7 million. Because look at this profit margin, 67.4%, and the contribution margin, 72%. So that's really where Peloton makes its money. That's where you get leverage on every single one of those classes that are made. You don't have to sell hardware. You don't have to ship products. You don't have to deal with those kinds of things. It's just a recurring revenue stream, and it's very, very high margin. This is fundamentally where Peloton wants to go as a company. And if we see this grow to $500, maybe $1 billion in revenue over the next 5 to 10 years, that's how this becomes a phenomenal stock. So there's a lot of headwinds and challenges that Peloton has faced over the last few years. As good as things were in 2020 during the pandemic, they got to be really bad late in 2022 and parts of 2023. But I think we're starting to see the turnaround take shape. We know what the strategy is going to be going forward. Now we need to start seeing that cash flow part start to improve. Management did say that they expect cash flow to be effectively break even on a full year basis. Now, this is after losing $83 million on a free cash flow basis. That was negative $83 million in the first quarter of the fiscal year. So the second half of the fiscal year, which will be the first and second quarter of the calendar year of 2024, is when they expect to start to generate significant cash flows. So that's what we're going to need to watch in both the fiscal second quarter earnings report, which will come out late in January, and also their guidance for the rest of the year. And maybe that balance sheet start to improve as well, because that's ultimately where there's going to be a lot of value. So watch those couple of numbers, the number of subscribers and then the subscriber revenue and gross margin. That's where the recovery is going to be for Peloton. But love to know your comments in the comments section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.